We have a lot to cover today, but before we do, JP Morgan has teams to support you at every stage of your growth. As former founders who have worked in local markets themselves, the bankers at JP Morgan bring deep sector knowledge and lived experience to their clients. JP Morgan can help you navigate complexity with confidence, backed by real-world insights and an entrepreneurial perspective. Get what your startup needs now at jpmorgan.com/grow-without-limits. JP Morgan is the bank of the innovation economy. And welcome to the Tearsheet Podcast, where we explore financial services together with an eye on technology, innovation, emerging models, and changing expectations. I'm Tearsheet Editor-in-Chief, Zack Miller. There's an old theory in lending that you can only master two of three things: growth, credit performance, and profitability. And for decades, this has been accepted wisdom until AI started changing the fundamentals of how we assess credit risk. Today, I'm joined by Paul Gu, co-founder and chief technology officer of Upstart. Paul's journey reads like a modern Silicon Valley story. From Chinese immigrant to Yale dropout, he became part of the inaugural class of Thiel Fellows before co-founding Upstart in 2012. Under his leadership, Upstart has gone from zero model training data points in 2013 to processing 91 million data points today. Their AI predicts both default and prepayment likelihood for every month of a term's loan. And Paul believes Upstart's AI is bringing them closer to achieving all three pillars of lending, an approach that could redefine consumer lending across the entire credit life cycle. We'll explore how this evolution is playing out, dive into Upstart's 2025 roadmap, including their push for 10x AI leadership and gap profitability, and discuss what this means for the future of credit. Paul, welcome to the show.
Thanks. Great to be here.
So I know we spoke to Upstart way back in the day with your co-founder, and I'd love to hear more your side of the story. Where did the idea come from to found the company? Tell us a little bit about the path at what brought you here today.
Yeah. So way back in 2010, 2011.
It's a long time now, yeah.
I dropped out of college to do the Thiel Fellowship. That was Peter Thiel's 20 under 20 program. It's the first year of this program, and the basic deal was you get $100,000 if you agree to drop out of college. It wasn't like YC or anything, no structured program. It was just a sort of social experiment to see if you could get 19-year-olds to leave school and then they could, figure it out.
And they did.
And so it took a little while. We first started I started thinking about this problem of young people getting access to money. And it sort of occurred to me that unless you came from money, it was pretty hard to get access to it when you don't have a lot of history of either income or employment or credit. And so I thought like it would be really cool if you could go ahead and invest in people like their stocks. And so that was sort of the very first sort of version of Upstart. I met my co-founder, Dave, and he was thinking about a very similar concept, and we kind of joined forces on the basis of that thing. Now, there was this other part of the story, which was I had spent a summer at this quant fund in New York called D.E. Shaw, a sort of well-known quantitative hedge fund that does a lot of kind of sort of like machine learning applied to predicting small changes in securities prices and finding little ways to arbitrage that. And this kind of not quite high frequency trading, but I think that's probably what's more popularly known. This kind of fairly medium frequency trading. It occurred to me that this was something that used a lot of compute, both computer and human compute. It was using a lot of intelligence, but it just never felt to me like it was solving an important problem for any regular people. And I wanted to do something that was like high frequency trading, but that would actually help people. And so when we started to think about this problem of young people not having access to money, very quickly it was like, okay, could you take some of the same things that are being done at all of these quantitative firms that are hoovering up so much talent, so much compute, but apply it to something that would help ordinary people. And so we ended up having this model-focused approach to pricing the risk of consumers. And then it just turned out we were wrong about one small detail, and that was this idea that people wanted this income sharing thing where you would have the upside and the downside, and you wouldn't know how much you have to pay back. And very quickly we figured out that was not the right answer. And instead, when people ask how much do I have to pay you back, you should just answer the question. And so that's how we came to the Upstart of today.
I love the fact that you guys started with the ISAs, and we've been in this long enough that every few years there's like a new class of young entrepreneurs say, "Hey, we're going to try ISAs again." I'm like, well, it's been tried and not successful before, but um, take us through sort of how the technology behind Upstart has evolved over that time period.
Yeah. So there are really a few major ways that the model makes progress at Upstart. You can think of it as there's rows of data and there's columns of data, and then there's the sort of model architecture. Those are the three major categories. If you start from the rows of data, when we started out, we had 0 rows of data. We had to rely entirely on third-party data, and third-party data has all sorts of limitations. It doesn't have the right columns of data attached to it. It doesn't represent the kinds of borrowers that will come to Upstart.com very well. Then columns of data is something that we've just added over time. So our initial thought was we were focused on younger consumers. So we said, let's add in data about someone's education. So alternative data to what's traditionally on a credit report. But over the years, we've added more and more data sources. We've said, let's add data about people's employment, and let's add data about people's interactions with their bank accounts. Let's add, what's now called cash flow data. Let's add data about, people's various kinds of public records that are out there. Let's add data about how people are interacting with us digitally. And so we've added more and more columns of data over the years. And then the third pillar is model architecture. And so when we started out with essentially what we call a textbook approach. The textbook, there literally is a how to do consumer loans textbook out there, many of them, in fact, and they all roughly guide you towards the same thing, which is you build kind of a roughly 5 to 10 variable logistic regression, really just a linear model that kind of assumes, things go up and down in proportion. And that model is the one that we started out with back when we had 0 rows of data and just relatively few columns of data, because that's all we had the data for. But as the amount of data that we had increased, we were able to spend time to build more and more sophisticated model architecture. So you go from maybe just having this one linear model to having multiple kinds of models that you're ensembling together. Then you're changing the base models. So instead of a linear model, you get to a tree-based model, and then eventually you get to sort of a neural network type of model. Then you have multiple kinds of these things. They get ensembled together. You've got multiple layers of the model. And so you end up with a very rich proprietary model architecture, and it can get more sophisticated almost in proportion to how much training data you've got. And so, as you mentioned earlier, the rows of data went from 0 to now it's about 91 million training data points. And that keeps going up. As it goes up, it unlocks the ability for us to develop more sophisticated models. But of course, it doesn't just come for free. You have to actually also do the technical work.
And your own business model has evolved during that time. I think you went from ISAs, you were doing direct lending for a while before you moved into this model. Is that correct?
You're right. We have evolved a lot. We've done actually all of the above, probably as far as business models. In our early history, we had a period of time we flirted with something like a P2P model. It was never quite fully P2P, but there definitely was a marketplace element that had retail, kind of a retail investor presence. We have done, of course, earlier when we didn't have the proof points in our model to show third-party institutional capital sources, we had to do a lot more of it.
Yourself.
Balance sheet. Some of the balance sheet, some of it was directly on our balance sheet. Some of it was kind of like, you would raise almost like friends and family money. So, really like you had to scrap in every possible way to get over that 0 to 1 hump where you're doing things in a different way than everybody else. And you don't have the proof points to show institutional capital that they should buy in and believe that. And so it took a good number of years for us to really get going. And there was a long time I always thought of us as kind of like the tortoise and kind of turtle in the hare race in the great lending or fintech race that was going on. We were always kind of the slowest company, and I think eventually the business model and the differentiated credit approach proved itself out. But there were definitely some dark years in there where we were wondering why everybody else was always so far ahead of us.
Right, and look where they are now, probably. But what I'm curious also is through that evolution of technology and the business model, like where you are today, how differentiated are you versus all the other people in the race, all the rabbits, I guess, and yeah, I'm curious to see and how that impacts, the way you compete in the market.
Yeah. The way we measure how differentiated we are is primarily through our model separation accuracy metric.
Mm-hmm.
This is a metric that measures how much better our model is at separating credit risk from compared to a traditional textbook model. And so this
Kind of like
metric
alpha
today.
in investing.
Exactly, yeah,
Yeah.
and it can be measured in a standard, repeatable, consistent way.
Mm-hmm.
So today, our model is 171% better at separating compared to a textbook credit model. And the flip side of that stat, the one that actually I think is more interesting to talk about, is the remaining inaccuracy to be solved. Today, there is the remaining inaccuracy to be solved today is 87.5%. What that means is if you started out at 100% inaccuracy, meaning like you just, you had all of this error left, when you start from that benchmark textbook model, and 0 would be you have a model that has gotten to perfect prediction, we're at about 87.5%. So doesn't sound that exciting. It sounds like, you've only made incremental progress. But of course, that on the flip side is translating into that 171%, which what it tells you is that of all of the variance that you could possibly explain, textbook models are explaining such a small percent of it. And we're explaining, almost 3 times as much now. But there's still so much room to go. The vast, vast majority of error is still out there. And it sort of means the universe is kind of this hard to explain, hard to predict place. It's not an easy problem to figure out actually which people are going to pay back when. And that means there's a lot of room for the models to keep getting better.
How does the evolution in AI technology impact the ability to get better at the models?
It's tremendous for us. We have definitely benefited from this incredible tailwind of both research and hardware progress on that's really, I think, driven in an economic sense by the boom in LLMs and kind of like foundation model technology on the generative side. And that's pretty different from what we do from ultimately at the bottom of the funnel. But from a top of funnel technology standpoint, it's great because a lot of the advances in whether it's the hardware of compute or the software that optimizes the efficiency of compute or the actual research into different kinds of neural networks or different kinds of learning algorithms, we can use a lot of that. And so we're kind of getting this free gain. And I think there just aren't that many companies that I think are quote unquote model companies. And I think before, you had OpenAI and Anthropic and these guys, there just really weren't any well-known companies that I think really made their business succeed or fail on the basis of how good their models were. And so it was always a challenge for us to even explain to anybody like how it could possibly be that you could build a business where your primary source of alpha was having better models. And now I think it's a lot better understood as a concept. And then, of course, those companies, the amount of money that they're pouring into all of this research and development, it's just a great tailwind for us.
It's great because in a way you're piggybacking their investments in technology as well as your own, of course.
That's
but
great,
I'm kind of curious though, Paul. Like, it's almost like your D.E. Shaw days. But I'm wondering like if having to continuously improve the model makes it a very competitive market to keep having to like improve the model all the time. Like there's no rest in that sense. I guess asked a different way, are there other ways to differentiate yourselves beyond performance?
Yeah, it's a good question. Certainly, I would say there is no rest. I think we do have a quite large competitive advantage from the modeling perspective. So I guess, you could rest probably for a while, but I think in the long run, you can talk about competitive moats like you have more rows of data. You've got these unique columns of data. We have all these sort of proprietary model architecture. Some of them are patented. Like all this stuff, it's real and it's good. But I think in the very long run, speed of execution is the only true differentiator, right? Like if you actually just decided to rest, then yeah, eventually others are going to figure it out and catch up. But I do think we have a very long head start. So that's I think it can both be true that we've got a strong moat there, and also that can't rest. So there's certainly no rest there. And as I said earlier, 87.5% remaining inaccuracy is like, there's just so much juice left to squeeze. And we're really only at the tip of the iceberg in terms of solving the problem for the end consumer. People have to pay, the single largest expense, either direct or indirect, on a consumer loan. Like why you have to pay interest on your loan is because people don't know if you're going to pay back. And the vast majority of that uncertainty, as I said, is still out there to be reduced. So, I think in terms of other ways we differentiate, there's certainly a lot, and I think many of them do ultimately come back to AI as well. So we think of it as like you can apply AI in the domain of underwriting and pricing the loans, but you can also apply it to automation. You could apply it to servicing. Really, like every part of the lending stack has this problem associated with it, and how much they matter is a function of how much of the interest of a loan tends to go towards covering that part of the expense. So for different products, it's different. So for example, in secured loans like home loans, we've been a lot more focused on applying AI to automation, just because if you think about all the manual steps required in doing any kind of home loan, today we're in HELOC, eventually we'll cover all the categories of home loans. It's a much bigger fraction than in, say, an unsecured loan. And so it's very important to take AI and apply it to the problem of automation in home. It's, about half and half in something like auto, where there is a lot of juice to be squeezed in automation, not quite as much as in home, but also some good juice to be squeezed in underwriting and pricing. And then servicing has been this great new frontier for us, where initially we started out as almost a correlation only company. We said, we're just going to find things that are correlated with repayment. We don't really care why they're correlated with repayment. But then at some point we said, well, wouldn't it be even better and more powerful if you could cause better repayment? And servicing is sort of the first way we do that. And a lot of times servicing sounds like, you're just calling people and saying the same thing over and over again. But I think when you take a machine learning first lens to it, you can start to do a lot of interesting things, and things can become very targeted. Of course, there's development of actual agents that can just start to do some of the servicing itself. And so there's a really rich surface space to explore there as an AI first company from a servicing causing better repayment perspective.
That's awesome. I think that leads to my next question. So that theory in credit that, business can never capture two of the three pillars. So growth, credit performance, and profit. I know you believe that the technology you're working on is able to not to have to sacrifice one for the others maybe. Can you talk about how that interplay would work?
Yeah. So this triangle model we have of credit is that credit has been around for a very long time, probably as long as human civilization. And that means that it is probably the most competitive consumer business in the world. You have, for any consumer, there are probably thousands of different lending entities that would be very happy to lend you money at some price. And so if you come in as a new player and you say, I want to grow really fast, I'm going to take a lot of market share from these thousands of players, some of whom have been around for hundreds of years, you really need to be doing something very different. Otherwise, your choices are essentially, the way I'm going to take market share is I will have a lower profit margin than them. Or the way I will take market share is that I am going to have bad credit, meaning I'm going to make loans to people that nobody else would approve, because those loans don't tend to pay back very reliably. And I think we've seen all of the permutations of these choices made over the last couple decades, where venture capital has come in and funded a lot of fintech lenders. And I think some of these companies not coming from lending have fallen victim to this triangle and chosen, two of the three or one of the three. And long run, of course, that does not work out. So our approach was always, if you really want to build a sustainable long-term business that can both win market share and survive and be around for the very long haul, it needs to actually do something that's fundamentally better. And I think very loosely, you can call that technology. In our case, it is actually technology, but in theory, it could be other kinds of things. For us, that technology is primarily about AI. It started out with AI applied to credit and underwriting and pricing. But as we've talked about, it has grown to being applied to the automation, the servicing, really every part of the process. And if you can do that, of course, then suddenly you're not just playing the zero-sum game between the 3 points of the triangle. You can actually grow in a way where you're growing because you are actually able to find more good borrowers from amongst the pool of otherwise rejected borrowers, and that's very powerful. Or you can actually win market share because you're able to offer a better price because you've eliminated more of the manual processes that have real operational costs, and so you can take that out of the system and pass those savings along to the consumer. So that's how we want to win.
Awesome. I think in the remaining time, Paul, I'd love to talk about the growth mode that you're in right now, some of your 2025 5 priorities and where you're headed in the future? Can we expand the aperture? Not the lending credit box, but the aperture. Yeah.
Absolutely.
Yeah.
Two broad thematic goals for us. The first is 10x our advantage in AI. The second is solve all of a consumer's credit needs across their credit lifecycle. And so the first one, I think, given the conversation is hopefully pretty self-explanatory. No rest at 87.5%. We have a long way to go. The models can keep getting much better. That means more rows, more columns, better model architectures. And we're just going to do that over and over and hopefully not even just not slow down, but go faster and faster over time and get some compounding benefits, get some tailwinds from the generative AI companies, and get to a 10x there. Then there's apply to every part of the consumer credit lifecycle and all of their credit needs. We started out as a pure point solution for unsecured consumer loans, which are by far the smallest part of the market. They are a very useful product. In some sense, they're the best product for what we do because they have so much risk and uncertainty at the very bottom of the payment waterfall. But for most American consumers, this is not a product they very regularly use. So then after that, we started building products in auto, which is the most ubiquitous credit product. I think 60% of Americans have auto loans at any given time. Home loans, we're just in HELOC now, but of course, the single and probably most emotionally meaningful credit product that anybody ever uses is the purchase of a home. So certainly that's something that long term we expect to be in. And then if you just think about the kind of like ongoing daily use type credit, I think that is something we aspire to solve for. So if there's something that the consumer needs in credit, I think ultimately we want to be there.
And how about you personally or professionally? I mean, as CTO, as co-founder, do you have any particular goals moving into the last part of the year or moving into 2026?
It's all linear. So if you want to get to, if you want to get to those 2 thematic goals over the course of say the next 3 years, then, this is 1/6 of that time. And that's the goal.
It sounds almost like you're doing things now that you didn't expect to have been doing a few years back, like the technology has advanced that much.
Yeah, I would say the single largest surprise for me has been we always were in this position in the market where we were so exclusively focused on what we called the future prime consumer, meaning people who today most others wouldn't recognize as prime. But because of some of the wins we've had in applying AI to areas like automation and now increasingly servicing, but also improvements we've had in applying AI to marketing and targeting, but also what we call the calibration part of the problem, which is the part of the problem that long-term capital sources really care about. Where if you're a credit investor, you really, really care about having maximum predictability to the cash flows of your investments. And if you can deliver that, then you can solve for lower cost of capital because there's less of a risk premium that they have to apply to you. And it turns out that's really important for the primer part of the market, which I think we are now much better able to solve for than before. So suddenly we find ourselves in a place where we think for close to 50% of Americans, we probably have just the very best rate in a market where, again, there are uncountably many players. And that spans both people who are quote unquote future prime, but also many conventionally prime people because we've been able to deliver AI-fueled wins on model calibration, which then have turned into lower cost of capital via more happy investors.
Paul, it's been great talking to you. Thanks for joining us on the Tearsheet podcast today.
Great. It's been great to be here.